How many of you find yourself sitting in the red far more often than you might like? Well, you're not alone. I was in a very similar position not that long ago, but what I did made all the difference. I actually analyzed several years of my own historical trading data, and I discovered there were some very obvious mistakes that I was making. I want to share those mistakes with you because I think there's a good chance you might be making the very same mistakes in your own trading. So in today's episode, I'm going to reveal 5 steps that I took in my own trading to help me stop losing. Now, being a trader means you're going to have losses. When I say stop losing, I don't mean that I never have any losses. But over the last 10 months, 230 trading days, I've only had 8 red days. 8 red days and 222 green days, including a 76 consecutive day hot streak. That's not by accident. It's not just because I'm wearing my Lucky Cactus shirt. It's because of these very specific steps I implemented in my trading. And here's what I'm going to challenge you to do. I'm going to challenge you to try implementing these steps in your own trading starting today and to comment back and let me know if these help you. I think they will. But as always, I want to encourage you to practice the new strategies you may be learning and these new rules in a safe and simulated environment before you put real money on the line. Those of you guys returning to the channel, make sure you hit the thumbs up because you know we're about to dive into a full-length training. Those of you guys who are brand new, I hope you subscribe to the channel and hit the thumbs up. Let me introduce myself. My name is Ross Cameron. I'm a full-time trader, probably best known for turning an account with less than $600 into more than $12.5 million of verified and independently audited trading profits. Now, I share that with you, not because I want you to assume that my results are typical, because they're not, but because I want you to know the person that you're gonna spend time learning from today actually knows what the heck they're talking about. So let's go ahead and dive into the screen share because we've got a lot to cover. This is the story of how I stopped losing. And we're gonna begin with step 1, where I'm gonna share with you my pre-trading checklist. This is a checklist that I perform each morning that helps me understand if I should be aggressive, defensive, or neutral. Now, this makes a lot of sense because there are going to be certain types of days where you want to put the pedal to the metal and be super aggressive. The market's hot, there's a lot of opportunity, you got to strike while the iron's hot, right? However, there are other days when the market is very cold, and this is not the time to take a lot of risk. So is it a day to be aggressive, defensive, or sort of neutral in the middle? So this is the checklist that I go through to help me make that decision. The first question is an internal question facing me. Did I sleep well today? Because regardless of the condition of the overall market, if I don't sleep well, I don't trade well. And I've learned this the hard way. I've taken overnight flights and I really don't sleep at all. I sit down in the morning to trade and all of a sudden I'm trading like a maniac. I'm not able to make good decisions in my trading about when to take risk, when to stop, when to walk away, when I haven't slept well. So for me, just as a first minimum viable level of where am I at each day and can I trade today, I have to ask myself, did I sleep well? Now, for some of you, you may want to ask yourself if you ate well. Have you had breakfast, especially depending on what time you get up? For me, in my earlier days of trading, I would ask myself, did I eat well and did I sleep well? However, that's when I began trading at 9:30 in the morning. During the pandemic, the time that we began trading moved back earlier and earlier and earlier to the point now where I start trading at 7 a.m. So usually when I sit down, I haven't eaten yet, but that's fine. That's not a problem for me. So the real question here is, did I sleep well? Now, number 2, do I feel emotionally centered and grounded? So let's just say, for instance, that I slept well, but I'm harboring some resentment and frustration over something else going on in my life, whatever it might be. I recently, and I'm very annoyed about this, but I recently was in a parking lot and I was parked very close to someone. Well, I thought they parked too close to me. They opened their door, they hit their door right against my car. I thought it was intentional. I was like, what are you doing? That's crazy. She said, you're parked near the line. I was like, listen, if I'm parked near the line, okay, give me a break. Don't slam your door into my door. Anyways, I'm going on a little bit of a tangent. I thought I was over it. In fact, I don't think I'm ever going to get over it. The way she spoke with me, I'm still offended. So sometimes you'll still be carrying a little something from the previous day, and that all of a sudden can have you trading with a shorter fuse. Now you're trading with a shorter fuse, you're more likely to get stubborn, to give in to frustration because you're not emotionally centered, you're not grounded. So doing that kind of internal checklist, I eat well, I sleep well, and how am I feeling today in terms of emotionally centered and grounded? Now, let's talk about some of the external checklists. How has trading been going during the last few weeks? Now, actually, this is still somewhat internal because this is how have I been performing over the last few weeks. And if I've been doing really well, then that leaves me to feel like I can probably continue doing quite well because I'm in a nice little hot streak. If trading has been going really poorly during the last few weeks, then I'm probably more inclined to feel like I need to slow down, pump the brakes, and just take it, one day at a time. Get in, get green, don't overstay my welcome. So then number 4, I ask myself, how was the market yesterday? Even if it's a Monday, how was the market on Friday? Now, if the market in the previous trading session was really hot, I typically expect that momentum to carry into the next day. And if the market was really cold, well, similarly, I expect that to continue into the next day. So then I also ask myself, how was my trading yesterday? Was it a good day, a neutral day, or a bad day? And then I ask, what were strong stocks yesterday? And were there some strong stocks yesterday? What were they? And if there were strong stocks, what are they doing now? Because sometimes you'll have a previous trading session where you'll have some stocks that make really huge moves, but then they completely reverse. And that feels like a bearish signal because yes, it's good they went up, but then at the end of the day, they came all the way back down. On the other hand, if they went up, they came down a little bit, but they're still holding up quite well. That could then present an opportunity for trading them on day 2 for continuation. And it also just speaks to the general momentum in the market and the sentiment that this stock that was very strong yesterday is still holding up relatively well. And so then traders are probably going to be looking for the next strong stock if we're not continuing to trade that stock that was still strong from the previous session. Then number 7, I ask myself, how's the overall market looking this morning? And when I talk about the overall market, I'm usually looking at the S&P 500. So is the market up, is it flat, or is it down? And if it's up a little or it's down a little, that doesn't really matter. But if it's down a lot, I want to be aware of that. And then I ask myself, what's the catalyst that's driving the market sell-off? Is there some global economic, political event going on? Because if there is, I should be aware of it. Or if the market's up a lot, is there something that's driving that? Because that could also, influence the way I should expect to trade in the market today, right? So being aware of kind of the big picture around me is really important. Some traders get so hyper-focused on kind of the 2 or 3 stocks they're looking at that they lose sight of the big picture. And you have to remember that all of the trades we're taking are within the context of what's going on in the overall market. So it's important to maintain that connection with the bigger picture. So then number 8, I look at the scanners. So the scanners that I'm using will tell me for my strategy specifically, are there some stocks that are up quite a bit this morning? So typically what I would like to see on the scanners are several stocks that are up 40, 50% or even higher than that. And then number 9, I ask myself if there's a sense of FOMO in the market, the fear of missing out. Because what I've learned is that when we have a hot cycle where there's a number of stocks that are making big moves, there'll be a sense of FOMO of, I don't want to miss the next one. So let's just say, for example, you have a stock that goes up 400%, starts at like $2, goes up to 4 to 6 to 8 to 10, just goes crazy. And it's a biotech stock. So a lot of traders are going to feel like, oh my God, I can't believe I missed that move. I might even feel the same way. And we're going to think to ourselves, the next biotech stock that I see that starts to move, I'm going to jump in it. And I'm probably going to be even more aggressive in hopes that we see another 400% move. And that's when you begin to see these back-to-back 300, 400% moves, and they're all in the same sector. And so we typically say that this is a theme in the market or a cycle in a sense, that we're in a little biotech cycle. But it can shift from different market sectors and different price stocks and different, sometimes it's international stocks. So whatever the current theme is right now, of the last stock that made a big move, traders are typically looking for the next one and expect the next one will look similar to the last one. So that kind of gets me in this mindset of this is what I want to be looking for right now. And is there some FOMO where as soon as something pops up, traders are going to jump on it really quickly? Because if there is, I can expect bigger moves. And if there's not, then I should be a little bit more cautious. So once I've done this pre-trading checklist, this gives me a sense of how I should position myself for the day. If I've eaten well, I slept well, if I feel emotionally centered and grounded, if trading has been going well for a couple weeks and the market was strong yesterday, my trading was strong yesterday, there were strong stocks yesterday that are still holding up, and the overall market's great this morning, the scanners are great, and there's FOMO in the market, boom, I'm going to be aggressive. If some of these don't quite match, I'm going to be a little bit more neutral. And if several of these are a no, I'm going to be defensive. And the one most important is that if I did not sleep well, I should not trade at all, because my ability to judge my own sense of like I can perform today is going to be off. When I'm tired and I haven't slept well, I think that I'll be fine, but I'm never fine. So I just have to recognize that if I didn't sleep well, I really shouldn't trade at all, which is why I prioritize making sure I get a good night's sleep each day. By the way, I'm going to share a PDF that you guys can download that's going to break down my 5 pillars of stock selection so you can understand very clearly what constitutes an A quality setup. So you can download the PDF, you can print it out, you can utilize it in your own trading each day when you're looking at stocks and trying to decide, is this A quality, is it B quality, is it C quality? So I'll put a link where you can download that PDF pinned to the top comment and in the description. When it comes to profitability, I really look at it in terms of 3 specific core components. So the 3 core components to profitability include your accuracy, which is out of all the trades you take, how many are green versus how many are red. So if you take 100 trades and you've got 60 that are green, you've got 60% accuracy. The second core component of profitability is your profit to loss ratio, the relationship of your average winners to your average losers. And the third is your consistency, which is over the course of the last several weeks, how many of those weeks have been green. So as I'm sitting right here today, I'm actually going to be at an 18 on the 3 core components. I give each one of them a score of 1. So you can get a total of 6 for each one of these components here. And so right now I'd be scoring, I think about an 18 or maybe it's a 17. We could just take a quick glance at my metrics. And this is going to be just over, well, we'll look at the last 30 days. So it's going to be a little less than 6 weeks, but it's close enough. I know that I'm green over the last 6 weeks. So over the last 6 weeks right here, my accuracy is 76%. Average winners are $2,500. Average losers are 800. So right there, I've got more than a 4-to-1 profit loss ratio, 76% accuracy. And then we look over here at, let's see, we'll pull up the calendar. We'll just close that out there. And so over the last 6 weeks, 1, 2, 3, 4, 5, 6, green, 6 out of the last 6 weeks. So this is obviously, I mean, anyone who's trading would love to be a 6 on each one of these core components. But how does that really happen? So profitability begins with accuracy. It starts with accuracy. So if you're not at, an 18, which would be like sort of professional trader status right now, maybe you're at a 3. You've got a 1 for each of these. All right, so you've got some room for improvement. Where do we start? Well, I'd love to be more consistent, but you don't start with just, I'm going to be more consistent. And I'd love to have bigger winners, but you don't just start with, I'm going to have bigger winners. I'd love to be more accurate. That's where you can start. You could focus on trading A quality setups. And later in this episode, I'm going to talk about the criteria for A quality setups. But focusing on A quality setups is the place to start. Because if you discipline yourself to only trade what you define as an A quality setup, your accuracy will improve. One of the biggest mistakes beginner traders make is they get impatient and they force trades out of boredom. They just feel like, I got to take something. I haven't taken a trade yet today. I've already been sitting here for 45 minutes, so I'm just going to trade this thing that's moving. And it doesn't meet their criteria for being an A quality setup, but they trade it anyways. And then they lose, predictably. And so when you trade low quality setups, you're going to have lower accuracy. And when you have lower accuracy, you're inevitably going to have bigger losers, which means it hurts your profit loss ratio, which means it hurts your consistency. So now if we go back to focusing on higher quality setups to begin with, accuracy improves, your average winners improve because now your ratio of profit to loss is improved because you've avoided the unnecessary losses that were coming from trading low quality setups. And then that helps feed consistency. And this becomes that feedback loop that helps you build self-confidence. And the right way to build this track record, of course, is to do it in a trading simulator where you're in a totally safe environment and you're not putting real money on the line. And when it comes to taking risk, we know that trading is risky. I'm not speaking out of turn when I say that. I think we all know very well that trading in the markets carries risk, but we do it for the reward. So it's a relationship of understanding risk and reward. And when it comes to trading, let's just say you risk $2 to make only $1. That's not really a good deal to risk $2 to make only $1. And you'd have to be right 67% of the time right here in order to be break even with that type of ratio. Now, as you just saw from my metrics that I showed you back up here, I'm trading right now where I'm risking about $1 to make, well, it's about $4, but we'll just round up to 5, which means I'd actually only need to be right about 17% of the time to break even. Wow. So all of a sudden the statistics are in my favor. If I can be right even just 50% of the time, I'll make great money. Now you combine all my years of trading and the educated intuition that comes along with all of that experience, and my accuracy is all the way up here around 75%. And that's why over the last 30 days, I've got over $600,000 in profit. So this really comes down to understanding risk and reward. Now, when you're looking at a setup, the question you have to ask yourself is, do I stand the chance to double whatever I'm risking? So if you're going to risk $10, you should have the chance to make 20. If you're going to risk 100, you should have the chance to make 200. If you're going to risk 10,000, you should have the chance to make 20,000. The number in dollars doesn't really matter. It's the ratio that makes the difference, because really trading is a career of statistics. You either meet the metrics of profitability or you don't. It's as simple as that. So in order to really focus on improving your metrics, we start with accuracy. So we start with accuracy. We start with accuracy. You build a track record of profitability. That increases your self-confidence. And when you've got higher self-confidence, you've increased the number of winners. You're feeling better about yourself. You're going to take larger positions. You take larger positions, you're going to make more money, right? So this is the positive feedback loop, and it all begins with accuracy. So accuracy is one of the most important things that you can focus on. And let me talk about what I do each morning to keep myself focused on trading A quality setups. It is step number 2, the icebreaker strategy. This is a strategy that allows me to test the condition of today's market with low risk. Now, the reason this strategy is so important is because one of the things that I discovered was that on my green days, my accuracy can be even higher than 80%. There are some green days where every single trade I take will be a winner, 100% accuracy. But on my red days, my accuracy could be as low as 30 or 40%. So that gives me the blended average of about 76%. Okay, so how do I know each morning whether or not today is going to be a red day or a green day? That's the big question that I was asking myself. So this icebreaker strategy I'm going to share with you right here, I developed after a big red day. And this is what big red days have typically looked like for me. I have one huge loss like this, and then I kind of go sideways, and then usually I take another really big loss. And I end up just having such a big setback, not only financially, but emotionally, that's really hard to recover. And I bet this is something that a lot of you can relate to. You take a big loss, and now you feel this, loss of self-confidence. You've had a big setback. You feel like you don't know what you're doing. And when you come in the next day, it's really hard to shake off what just happened. And so now you're carrying with you the emotional baggage of that loss for several days, sometimes weeks. It can take months to recover from these losses when they're really big. And it feels like it was totally avoidable. Because I look back in hindsight and I say, why was I so aggressive on the day when the market was clearly difficult? It makes no sense. What was I thinking? And I realized on those days, I wasn't focusing on A quality setups. In fact, what I was trading most of the day were my own emotions. And that's because I made a critical mistake. So let me talk about that mistake. And let me talk about this big red day that I had. So I had a big red day. And what happened for me was I decided to take a step back and look at my metrics. I usually do this. If you've ever watched that movie, Apollo 13, in that movie, when they're up in the shuttle and they call down, they say, Houston, we have a problem, da, da, da. They're down there in Texas, in Houston, Texas, and they're trying to figure out, okay, how do we create a oxygen, carbon monoxide scrubber with just the things they have in the shuttle? So they take everything that they have in the shuttle and they throw it on some tables. And they're like, this is what we have to work with. Let's put our heads together and figure this out. And so whenever I have a really bad day, I'm kind of like, Houston, we've got a problem. And so I throw all my data on the table and I just started asking myself, what do you see? Do you see a pattern? Do you see anything in here that could give you some indication that, you should have stopped sooner, or something that could have helped you avoid this unnecessary loss, what felt like an unnecessary loss? So I looked at all my metrics, and what I discovered was that my accuracy on my red days, on average, was only 46%. 46%, that's terrible. On my green days, it was closer to 70%. Right now, it's even higher because of some of the steps I've implemented in my trading, including this icebreaker strategy. So I asked myself, is there a way that I could know that today is going to be a red day sooner so I could stop trading? So let me present it to you this way. What if I told you tomorrow is going to be a red day for you? What would you do with that information? I hope you would take that information and you would just not trade tomorrow. Now, what if you took one trade tomorrow and then I told you today's going to be a red day? What would you do? Stop trading. Just stop right there. Walk away. Because if it's going to be a red day, well, I guess you could say if I lost a ton on the first trade, maybe I can still make back a little and it's just a smaller red day. But that's not the right way to think about it. If it's going to be a bad day, you got to take your foot off the gas as quickly as possible. So now I was kind of asking myself this question of, what are the warning signs that could help tip me off that today is going to be one of those red days as early as possible so I can walk away, so I can stop trading? That was what I had to figure out. Now, at that time, this is what my typical green days would look like. I would take pretty big share size on my first trade, and when it worked, I'd immediately be up $5,000, $10,000, maybe even $15,000 in a couple of trades. Usually most of it would be in that first trade right then and there. So on this day, I was up, looks like about $12,000 on the first trade of the day. That's awesome. But on the red days, which didn't happen all that often, but they did happen more frequently than I would have liked, I would typically have a really big loss pretty much on my first trade. And so this is what I discovered. I realized that maybe, just maybe, I shouldn't start the day with such a big position on my first trade. Now, at the time, I had a daily goal of $5,000, and my daily max loss was also $5,000. But my goal was to only have, at the most, one red day each week. So 4 red days a month. And if I could do that, then I'd end up having a pretty good month, $60,000, $75,000 of profit, $750,000, $1,000 to $1 million a year. At that time, my max position size was typically around 20,000 shares. So that meant I really only needed to get 25 cents per share of profit out of the market in order to be up $5,000. But when I tried to swing for that big 25-cent winner with full size on the first trade, yes, it was great when I got it. I got a quick winner. But when I didn't, when I would lose, I'd be down 5,000, sometimes even more on that first trade. I proposed a change. I capped my share size at 5,000 shares, which is a quarter of my full-size position, until I make my first $1,000 in profit. So to make $1,000 with 5,000 shares, I need to make 20 cents per share. So 20 cents a share, 5,000 shares, is $1,000 of profit. Now, if I hit that $1,000, immediately scale up to full-size positions, but only after first getting myself that cushion of the first $1,000. But if I never cross $1,000 in profit, I'm locked at quarter-size position. So what does that do for me? Well, here are the results. On the best days in the market, I make $1,000 on the first trade and then immediately scale up. So I do sacrifice a little bit of profit on that first trade, but when the market is hot, there are typically dozens of trades and opportunities each day. So sacrificing a little bit of profit on that first trade because I'm trading with 1/4 size instead of full size doesn't really stress me out that much if, on the other hand, on the cold days, I stay at 1/4 size for the entire day. Because what that means is on the cold days, I don't expose myself to high risk. Those are the days I'm not producing profits, things aren't working, my accuracy is lower, so I keep myself throttled down and restricted, and that means that even on those cold days when I'm red only at the rate of trading with 1/4 of my position size. So my loss is 1/4 of what it would have been, 25%. Now, not only is it only 25% of what it would have been had I been trading with full size, I would argue the losses are even less than that. And here is why. Because what's the problem with trading full size on that first trade and having a loss? So first trade right out of the gates, full size with 25,000 shares or 20,000 shares and I lose 25 cents, I'm down $5,000. I'm in the red $5,000 on my first trade. So now I'm thinking to myself, in order to get back just to flat, let alone to my daily goal of plus 5,000, I now need to make 50 cents per share. And so what does the anxious, frustrated, and stubborn mind tell you? Take 50,000 shares right down here. All you need to do is make 10 cents per share, and then you're going to be right back to break even. And so the problem is, and I hate to admit it, but that's the cycle of revenge trading that so many of us fall into. And we think, in order to get back even, not just to flat, but to green on the day, I'm going to have to take bigger size. So you have a max share size, but it ends up that you far exceed it. And now this is terrible. So the only days that you're going to take reckless share size, like 50,000 shares, would be on the days when you're red and the market is terrible. That's so dumb. So then on the days when the market's really hot, you're just going to stay at 20,000 shares because you're not feeling emotionally hijacked. You're not revenge trading. So then it's almost like you're capping your upside because you're trading with smaller size than you do on your red days. So by trading with quarter size position, not only do I reduce the loss by 75%, I also reduce the emotions. Because now it's like, okay, yeah, I'm down on that first trade, but instead of being down $5,000, I'm down $1,000. No big deal. All right. When my average daily goal is 5,000, being down $1,000 doesn't bother me. So I take another trade and then I lose another $1,000. Maybe I lose another $1,000 and I'm down 3K on the day. That still doesn't bother me. That's not a big red day compared to my average. So, the thing is with daily max loss is that while the daily max loss was 5,000, I often found myself finishing the day far below it, which meant at that time, I wasn't very disciplined about walking away when I was red. I would get stubborn, and it was because I was taking too much risk on my very first trades. So these were the results. And my observation was that my confidence became a lot higher. I would have red days, but they were small, they didn't get me shaken, and then they wouldn't throw me off my kind of emotional center for several days. Now, this was the data, all right? So this was the data that supported this change. Now, so this is right now. So this is very interesting. These are comparing winners and losers. So I'm just gonna look first at so let's look at the average cents per share. So the average cents per share of my loss is 9 cents. So my losses are averaging 9 cents and my winners are averaging 12 cents. Now that's good. The winners are slightly bigger than the losers, but then let's go down to the size. So in terms of profit. So the winners are $2,000 on average, while the losers are only 800. So if I took 10,000 shares on my losing trade, I'd be down 900. So that means on my average losing trade, I'm in with a position of less than 10,000 shares. And on my average winning trade, I'm in a position of nearly 20,000 shares. That's not a coincidence. It's not a coincidence that, wait a second, how is it that your winners, you're in double the share size as your losers? You would think that wouldn't make sense. You should have the same share size for your winners and your losers. But But it does make sense when you recognize that the days I'm most likely to accumulate losers will be days where the market is colder, and therefore I'm throttled back trading with smaller share size. And then secondly, I have a strategy which is scaling. So when I'm in a trade, I've already got my $1,000 cushion. We have a stock that's going up, and I'll just show you, give you a little example here. So we have a stock that's popping up like this. It pulls back just for a moment like this. I take a starter down here. So the second this candle makes the new high right there, I take my starter of, let's say, 10,000 shares. So I take my 10,000 share position, and as it breaks through the high of day right here, mind you, I already have my $1,000 cushion. I take another 10,000 shares. So now I've got double position, and then when this stock squeezes through the high, I'm taking it all off the table. However, if as soon as I had gotten in right here, this ended up reversing back down, the loss is still only with 10,000 shares. So the trades that work immediately and are working in my favor, I double my positions on them. And then the trades that are not working well, I usually don't end up scaling in and going to full size. So just because I can go to full size after I've made that first $1,000, I'm still asking myself whether or not this stock currently, right now, is worthy of continuing to add to that position. So the data supports not only the scaling, but also this approach of the icebreaker strategy. And I think this is really powerful. So here we've got on the losing trades, $334,000 in losses and $2.4 million of profit. So that's about 1 year trade days. So now let me show you 2021. 2021 was prior to me implementing this change that I'm sharing with you here on the icebreaker strategy. So we're going to go to win-loss expectation. Actually, you know what? I want to go to compare. I'm going to go to compare here. I'm just getting turned around. All right, so we're going to compare, and I'm going to go winners, and we're just going to do we'll do last year, and then we're just going to change it to 2021. And then we'll do losers, and again, last year, but we'll change it to 2021. So this is going to be kind of dramatic. I want you to see how big the losers are. Oh my goodness, you guys, this is $5.8 million in losing trades. $10 million in winning trades. I had a good year, but you know what? Think about how much better that year could have been if I knew then what I know now. My average losers were 26 cents on average. My average winners were 18. That's not great. It's true that I had a lot more winners than I had losers, which is why I made so much money. But my average winners were 2,200. My average losers were actually 2,500. So arguably, this year, just year to date, these last 5 months, 6 months, have been far better than 2021. And so I realized that perhaps making more this year isn't about having any big home runs. It could be just about minimizing my drawdown, minimizing my losses, getting better at taking my foot off the gas when the market is cooling off. And that's something I see so many traders struggle with. The market cools off and they're still swinging with big positions and they're taking unnecessary losses. And so then what's the result? What does the equity curve look like? You've got a nice period of progress, and then you have a sustained drawdown, and then another hot market, and then a sustained drawdown. Whereas someone like me is trading, kind of like this, and then the drawdowns are really small because I'm self-correcting a lot faster. And this is a difference between a trader with 10 years of experience, a trader with, maybe 1 year of experience, and then you have a trader down here, who's maybe got 1 month of experience and is kind of like break even. So, we're all in different places sort of on this curve, but it took me a long time to get here. And I have to say, I feel so grateful. I feel so grateful that I was fortunate enough to turn the corner. I mean, I feel like part of it was just sheer luck. It was the luck of the draw that I happened to be the type of person that was tracking my data on all of my trades with such detail in Excel when I first started trading. If I hadn't been doing that, I wouldn't have had all of this data to mine all those years back when I first discovered the 5 criteria of the stocks I made the most money on. That was one of my first discoveries. And that was a discovery that came after a big red day. So going back and being able to look at my data has been really, just incredibly powerful and beneficial in my trading. And I'm so grateful for that I want to share it with you guys in hopes that it helps you in your trading as well. So I ended up being green 222 out of the last 230 days. So there's a couple red days in here, but they're small. And this is nearly $4 million of profit in the last 10 months. So typical days now, I do start a little smaller, but then I scale up. So I might even go red, but I don't get emotionally hijacked. I recover to green, and then once I'm up over 1,000, I can size up. And on days that I go red, typically, I'm able to walk away pretty quickly. So this has been a huge improvement. And I ended up having a consecutive day hot streak of 76 days in a row. In fact, I actually argued, in theory, that I could probably avoid ever having another red day again. Whoa, is that for real? Well, I thought that if I can maintain 70% accuracy with a 2-to-1 profit loss ratio, that as long as I can always take 10 more trades each day, I should always be green. But there is an exception. What if I run out of A quality setups? And that is the biggest problem. So in a hot market, A quality setups for me can produce 75 to 80% accuracy. So even in an A quality setup, I can still have losing trades on. But I generally do really well in a hot market with A quality stocks. Those are stocks that meet all 5 pillars of stock selection, which I'm going to walk you through later in this class. And typically there'll be 10, 15, 25, maybe more A quality trades each day in a hot market. If we go back to my detailed calendar here, let's see, so we'll clear this out. So we'll just look at the last, the last few days here, a few trading sessions. So 16, 17, 32, 17, 4, 6, 49, 16. Now, most of these days, I was trading a combination of A quality and B quality setups. Why would I trade B quality setups? In a hot market, trading B quality setups can still produce 70, 75% accuracy for me. And there's going to be a lot more B quality opportunities each day. So there's sort of an interesting curve here where as you increase the number of trades you take, you're inevitably going to have to decrease the quality standard to open up more opportunities. And that will produce what I found is, so the more trades you take, the more money you'll make, and then you'll start losing. So as we go from, let's see, this is going to be, so this here is total profit. So total profit going up and down, and then this is going to be the total quantity of trades. So when you get up here, you're doing just, A quality setups, you're going to do well. You introduce some B, you're going to do even better. And then you start to go to C, and well, maybe C is kind of like here. You start to go to C quality, and you're kind of going sideways. Now that's in a hot market. In a cold market, it might look more like this. So in a cold market, you may not be able to get past B quality. You start doing C quality setups in a cold market, you're just going to be losing money. So it's important to know the market you're in. And so what I've found is that in a hot market, trading A quality setups, which are setups that meet all 5 criteria of stock selection, and trading B quality setups, which meet 4 out of the 5 criteria of A quality, are worth trading. But in a colder market, even A quality setups don't work as well. And certainly B quality doesn't work as well either. And you start to get into C quality and lower, and it's not even worth it. Why is that? Well, in a hot market, buying sentiment and FOMO are so high that B and even C quality setups can work. But in a cold market, sentiment is so poor that even excellent stocks with great news may not perform nearly as well as they would have with the exact same headline during a hot market. And that can be very confusing for traders to understand. Wait a second. These are both stocks that have all 5 pillars of stock selection. These are both stocks with similar headlines. In a hot market, it goes up 400%. In a cold market, it goes up 50%. I don't understand. And it's the influence of market sentiment. You can't underestimate how important that is. So in a hot market, things feel really hot. In a cold market, they can be really cold. And that's actually, I would say, there's a blessing and a curse there. Because when the market is hot, there's going to be more opportunities because there's more stocks that are moving and there's more people trading, which means there's more liquidity. So that means you could trade more and you could trade a bigger share size. What does that mean? More profit. But in a cold market, there's fewer opportunities. So the total trades you take are going to be less. And because it's cold, there's usually less liquidity and you feel you have to reduce your share size. So then it kind of almost exaggerates the extremes in how much you can make when it's hot and then how slow it feels when it's cold. And this is part of the reality of trading and the reality of the markets, that it's ebbs and flows and ups and downs. So now let me share with you step 3, specific mistakes to avoid. Number 1, I have to avoid taking a full-size position on my first trade. If I take that full-size position on the first trade, then all of a sudden my back is up against the ropes if I lose, and I'm going to be more likely to fall victim to emotional hijack, revenge trading, and begin that downward spiral. When we're talking about that downward spiral, it usually begins with a loss. So losing money, which means poor accuracy, bad accuracy. And what does that create? An emotion of sadness with tears sometimes streaming down both sides of your cheeks. This is very sad. And so out of that feeling of sadness, anger, disappointment, you don't want to feel this way anymore. What's the best way to not feel this way anymore? In this little thinking cloud, what are you thinking about? Making back that money I just lost. So what's that going to lead you to do? Take another trade. But now you're doing it from a place of emotion. Are you thinking about A-quality setups or just anything that's moving? Anything that's moving that gives you a chance at making back some money, and you end up losing more. And you feel even more frustrated, and you take even more trades, and wow, that is the negative feedback loop. That is a downward spiral. So let's reverse all of that and go back to the positive feedback loop, which starts each day by focusing on what? Accuracy. A+ quality setups. You trade that, you're more likely, not guaranteed, but more likely to make some money. You start to build a cushion. Now you're going to increase your share size and increase the profit. And now this is a positive feedback loop. This is where we want to be every day. I want to help you cultivate this mindset, because this is night and day from that negative feedback loop. You just don't want to be there. But I've been there and I know how frustrating it can be. So the pathway out is by focusing on accuracy. Number 2, the biggest mistake to avoid is taking my first trade on a low quality stock or a low quality setup. Now you could have a good quality stock, but you trade a poor quality chart pattern, and then that's still a problem. So first things first, A quality stocks, and then the next is A quality candlestick chart patterns. Number 3, a very common mistake is getting frustrated that I missed a good entry and then chasing it. Ugh, that is a really tough one. Sometimes it'll happen where I'll see a setup, it's A quality, everything's great about it. I try to get in, I don't get any shares filled, and it goes without me. And then out of frustration, I just jump in at the very top, and then I'm in way up here and it drops. That's not good. And then basically I'm back in the position of having an unnecessary loss on the first trade because I gave into a low quality setup. So this all requires patience. Number 4, do not overtrade the backside of the move. So when a stock is moving up nicely, what we generally see on the uptrend is that it's stair-stepping up. You've got a couple nice candles that are going up, and then you've got, where's my red pen? Then you've got a red candle, a couple more green candles, and then a red candle. And this is the area where I'm buying the dips and we're trading the breakouts. And of course, this stock meets all 5 pillars of stock selection. Then it pulls back a little bit more. It pops up here, doesn't make a new high, and it dips back down a little bit more. This is where now we're on the downside. How do we know we're on the downside? Because we're no longer making new highs, and each time it actually is making a new low. So here, what were we doing? We were stair-stepping up, right? So we were going up, and now we're actually stair-stepping down. So once we make that first pivot right here, and we begin breaking to the lows relative to the last pullback, that is the place to say, nope, this is now the backside of the move, and I've got to step back and slow down. So I've found that I make the most money on the front side of the move on this first leg up, and that really I'm usually better off not taking any more trades once it's broken down right there past that point. So aggressively trade the front side of the move, and then once that's over, I've got to wait for the next stock that's on the front side of its move. So these mistakes in my own trading were causing unnecessary losses and creating a lot of stress and frustration, as I'm sure they do with you. So developing awareness about these mistakes, so you're now conscious of them and you recognize that these are the things that I need to be mindful of each day so I can avoid making these mistakes in my own trading. That's critical. Step number 4, you need to have rules about when to stop trading. Now, I'll share with you a book over here. Where is it? Let's see. I've got a couple different books. I'm going to share one of them with you. This book is called Thinking in Bets by Annie Duke. And in this book, she talks about making decisions when you don't have all the facts. And that sure sounds a lot like trading, because of course, we don't have all the facts when we're trading. We work with the information that we have, and then we have to make a prediction of what we think is going to happen next. In her second book, Quit, The Power of Knowing When to Walk Away, she talks in quite a lot of detail about this struggle of not overstaying your welcome. She's a professional poker player, and although her experience playing poker is different from trading, there are some similarities that overlap with not wanting to overstay your welcome. I usually say every day you're doing one of two things. You're either leaving money on the table or you're giving back profit. And I personally would rather leave money on the table knowing that I'm walking away each day with a little profit in my pocket. So I take the approach of walking away earlier, and that has made all the difference. So rules about when to stop trading. If I give back 50% of my gains after crossing my daily goal of 5,000, I walk away. Now, I say after crossing my daily goal, because if let's just say my first trade was a $500 winner, and then on my second trade I lose $300, I'm still basically, for me, at break-even territory, so I don't consider that to be a point to stop. But if I make $5,000 and then I give back half or 50%, then I need to stop before I give back more. And by doing that, I'm able to preserve that consistency of green days. I'd rather have small green days, and then when the market is hot, I'll have big green days to make up for it. But if the very fact that I've given back half of my daily goal should speak to the fact that this is not the time for me to be continuing to trade, right? This seems like a logical place to walk away. So I set the rule and now I follow it. Number 2, if I have 3 losses in a row that are large enough that I'm frustrated, I walk away. This is a little tricky because this requires an honest assessment of, am I frustrated? And what's the difference between being a little annoyed and being truly emotionally compromised? And that's a fine line that you'll get better at identifying as you gain more experience. It's always better to err on the side of caution. So if these 3 losses equal 50%, then I have to walk away because that hits this rule. But if the 3 losses are really small, let's say I'm up $5,000 and then I have 3 losses in a row that are each $75. So I'm down $200. I'm not going to feel emotionally hijacked. I don't care. But if I have 3 $1,000 losses in a row, well, then I've given back half, and maybe I'm up 10,000 and then I have $3,000 losses in a row. So I haven't given back half, but I am frustrated. And especially if you have 3 losses back to back on the same stock, it can feel really infuriating. So that can be the time to say, you know what? All right, I think I'm done with this. That actually happened to me today. I was having a pretty good day. And then I had a stock that I traded, and first trade was green, second trade was red, third trade was green, fourth trade was green, fifth trade, I gave back everything I made on the first trade. And I was like, okay, I'm frustrated. And actually, it was only 1 loss, but it was enough that I said, I'm frustrated. And so I also would say that it's really important to recognize your inner voice. Sometimes that inner voice will say to me, I should probably walk away. If you're saying that, you should, and you need to, while that inner voice still has any degree of control. Because if you keep trading to the point of getting emotionally hijacked, you're not going to listen to that inner voice at all. Number 3, certainly if I hit my max daily loss, I have to walk away. But fortunately, the majority of days that I'm walking away not because I hit my max daily loss. And actually, I would say, in fact, this may bring up another really interesting thought, just as I think about it right here on the spot. So most of the days that I walk away, I have not walked away because I gave back 50% of my profit. I'm not walking away because I had 3 losses in a row, and I'm not walking away because I hit my daily max loss. Each of these days back here, I'm walking away for a different reason. What was the reason that I walked away? Well, in fact, the reason on these days was because I ran out of time. Well, I have a window each day when I trade. So if we go to my detailed P&L here and we go down to days and times, you'll see pretty clearly that I make the most money during this window in the day. Now, this is also the time of day that I trade the most, as you can see here, but I trade the most there because I know that I make the most there. If you look at these hours here from 11 a.m. until 5 p.m., I have a decent quantity of trades over the years, but not a decent quantity of profit. And so it took me some time to really learn that about myself and realize that, you know what? Why don't you get yourself that time back in the day and just stop right here? So at this point, I'm stopping a lot earlier in the day. If we looked at, than I was several years ago. So if we look at my trading now, you're going to see that I really have very few trades later in the day, although they still really don't contribute any meaningful profit, which is not surprising. And I probably on those days should have stopped sooner. So for me, running out of time is going to be what causes me to walk away. So that could be, I suppose, a fourth rule of when to stop trading. I don't see why not, really. I mean, that is a good rule. So number 4, the window of profitability, profitability closes. All right. So once that window of profitability closes, then that's the time to walk away. One of the biggest struggles that a lot of beginners face is knowing when to walk away. They're afraid of missing out. And you know what? I'm afraid of missing out. I don't like missing out either. But I've learned more and more as I've gained more experience over the years that at the end of the day, I have to focus on being consistent. And I can't spend all my time worrying about all the things I'll miss. You know, you could be trading 24 hours a day. You could trade crypto. You could trade Forex. You could trade futures. We're all missing stuff. Don't spend your time thinking about everything you're missing. Be grateful for what you've got, and be grateful if you found a window during the day where you can produce consistent profits. Step number 5, analyzing results and making improvements. As I said earlier, this is one of the most important things in my own trading. The fact that I track all of this data and then I make efforts to improve my performance. Now, if I hadn't been tracking these metrics, I wouldn't have discovered my 5 criteria of stock selection. So this is what they are. Number 1, I won't trade if something's not already up 10% on the day. Number 2, it needs 5 times higher volume today than its average. Number 3, there should be a news event that's moving the stock higher. This is the one item that sometimes we won't have it, which makes the stock a B quality setup, but I'll still trade it because it's moving. Number 4, most traders prefer stocks between 2 and 20. This is just the popular price range. And number 5, the float, which is the supply or the number of shares available to trade, should be less than 10 million. Now, less than 20, less than 10, less than 5, less than 2. Lower is better. Generally, if I see something that's 15 or 18 million shares, but it meets the other 4 criteria, I'll trade it. These can be a little bit of working roughly within, but a stock should be pretty closely within these 5 criteria. Now, it's true that there are exceptions. GameStop was an exception. It was exceptional. It made a huge move. I had an amazing, year when GameStop, had that short squeeze, but that's not something that happens every day. So as a trader, as you gain more experience, you'll be better equipped to know when you should trade outside your sort of boilerplate template of this is the type of stock that's perfect for me. But as a beginner, it's really best to trade within this zone. And that actually, brings back up this book by Annie Duke, Thinking in Bets. She said when her brother taught her how to play poker, he said, these are the only hands that you should play. And he gave her a set of hands. He said, if you don't get these cards, then just fold. Don't play. And she said, well, I don't understand because I see other people playing different sets of hands. And he said, yeah, well, they've got a whole lot more experience than you do. You're brand new at this. I only want you to trade the hands that have the highest percentage of success. And that makes a lot of sense. And so as a beginner trader, I think there's that same approach of only trade the setups that have the highest percentage of success. Stay really focused on like the real like system of this is what works generally speaking, and don't pay much attention to the exceptions. So each day when I'm sitting down, how am I finding these stocks to trade? I'm using these scanners right here. These are the scanners I've developed over the past 7-8 years. I have a development team that works for me at Warrior Trading. We've got these scanners that we've built out. And once I find the stock that's on the scanners, then at that point, I'm pulling up the candlestick chart. I'm looking for my entry, buying the first candle to make a new high, and then riding that momentum as it goes higher. This is a trade just from last week, $27,000 in profit. This is another trade from last week as well, $35,000 on the day, trading a micro pullback. And as always, breaking the ice with those first couple of trades, which in this case was a $3,000 winner on this stock, a small $200 winner on this stock, a $400 loser on this stock. So I was already up about $2,500 on the day before PTIX came up on the scanners with breaking news. And as soon as it popped up, I already had the cushion. I was able to size up quickly. And although maybe I sacrificed a little of my profit on those first couple of trades on the day on BCLI, I think it was worth it to have this really nice green day and know that my red days are staying small because of these steps that I've implemented. So I encourage you to try to implement these steps in your own trading and let me know what it does. Now, as always, if you want to learn more from me, you can always check out our 2-week trial at Warrior Trading, where you can watch over my shoulder as I'm trading in the markets live every morning. During your 2-week trial, you'll have access to the same software that I'm using for charting, scanning, breaking news. You'll have access to our chat room community, and we'll give you a selection of classes from my full-length Warrior Pro curriculum. So if you're ready to take the leap, we'd love to have you join. Now, those of you guys that got a lot of value out of today's episode, I hope you hit that thumbs up. I hope you are subscribed to the channel, and I'll put links to a couple other full-length trainings that I've uploaded right here on YouTube for those of you guys that want to keep learning right now. Thank you guys as always for tuning in, and a reminder, trading is risky, my results aren't typical, so please manage your risk, take it slow, and always practice in a simulator before putting real money on the line.